All right, I will go ahead and call the Special Finance and Budget Committee meeting to order.
Recording in progress.
Do the roll call?
Councilmember Kelly? Committee Member McMillan? Here. Councilmember Nguyen? Here. Councilmember Nuzma?
Here.
And Chair Livingston.
Here. Okay, very good. So we have a quorum. It's good. All right, so we'll go straight into public comment, if there is any.
Hi, and thank you again for having this committee and really diving into everything and passing getting the pension on track. I have two questions. I just would really, at some point, love to know where I can get this addressed. One is we had that surplus, and I have yet to see any accounting, and I don't know where to look for that. So if you, during your meeting, if someone could explain how residents can find out how that $50+ million has been reallocated or what it went towards from the surplus, that would be really good. I also am hoping that we will not pass bonds this year, being as if we budget properly, we probably will not need them. And I'd love it if we could get to a point in this city where we do what a lot of other communities do, and that is save, plan your projects well out, and then save your money, get it financed properly, and not always be borrowing money and embarking on huge projects that the taxpayers just don't have the money for right now. But I think you guys are doing a fabulous job, so thank you.
Very good. Is there any online public comment?
I'm phoning in, if you can hear me.
Okay, sure. And who is this?
So my name is Mike Vasilko. Live at 2728 Reese in Evanston. So I'm kind of echo Mary's comments, and I also agree with her. This committee has been a lifesaver in many regards, so I appreciate that. But and you've made progress on lowering the debt, as I understand it. But why turn around and go back to borrowing more money? So on item D3, if I understood it correctly, you want to borrow, or somebody wants to borrow $13 million. And as Mary said, come up in many there's this excess money, this unassigned $53 million, give or take, that was out there from previous years. That money should be used, if it's out there, not borrow new money. Average person like me, not a finance wizard, plus two things. So I would appreciate not passing any GO bonds this year because they do not appear to be needed. Thank you very much.
Okay, very good. We will go straight now into the review of the annual comprehensive financial report. And I will say that the comments that were both made, we hear them, we're going to talk in more detail about them, because specifically the current excess reserves, there are some projections about how we, at least current projections, got a lot of work to do, because I would say, particularly on the expense side, but there will be some usage, as currently projected, of the excess reserves over the next couple of years. So we'll go through that, and that should help at least people know where we are today in an excess reserve position, how that unfolds over a few years. And again, there's a lot that has to go into what exactly those projections and budgets are going to look like. But that is, they're just like this year, there will be some eating into the existing excess reserves on an amount that we'll all manage to minimize. And then on the bond side, we'll talk about that too. I think one element you have to think about on bonds is that over the last couple of years, we have had $30 million of bonds come due, approximately that number, since we last did a bond issuance. So bonds sort of do two things. There are new projects, but also there's an element of prior issued bonds that have matured. So the amount of asked for bonds is less than what has matured. You know, it would just not be feasible to pay off all of our outstanding debt over a short period of time. If we have maturities, it's always great if we could issue less, but there is a sort of a constant inventory of bonds that come due, is one way to think about it. And we'll talk about that more. We'll talk about that more when we get to that section. Okay, so now we'll go over the financial report. The 256-page financial report. Whatever, maybe not 256, whole agenda.
Good
A lot of
evening,
work in this. Yeah.
Chair and the members of the committee. We have Martha Turner from Sekich, our auditors, so she would briefly go over and kind of then take any questions since the audit report is now final. Martha, take it over.
Thank you, Hitesh. Thank you, council members. I am here tonight with you to present the results of the financial statement audit for the fiscal year ended December 31st, 2022. As Hitesh noted, the annual comprehensive financial report and the other reports that are issued alongside the audit are final and out. It is a lengthy report. I'll be very brief and just summarize and highlight some of the key points and then open it up to questions. Within the annual comprehensive financial report, there is an introductory section, and in the introductory section, we do include the Certificate of Achievement for Excellence in Financial Reporting that was awarded to the city for the fiscal year 2021 annual comprehensive financial report. This is a great distinguishment awarded to the city by the Government Finance Officers Association, and that is included within the introductory section to show it is awarded for excellence in financial reporting, transparency of the financial statements, and the information presented within the annual comprehensive financial report is deemed transparent and clear and understandable and meets the requirements of the Government Finance Officers Association. Also within the introductory section, you will find the management discussion and analysis, and that is prepared by the finance department. That is a great section of the report to look to which summarizes, provides an executive summary of the financial statements and provides some additional context that isn't included in the numbers themselves. So it gives a little bit of comparative analysis of current year to prior year results and gives some analysis and discussion as to the reason for the changes and the variances. So that's a great section to look to. It is prepared by finance and accounting and is a great place to take a look to just gain some context. That's page numbers MD&A 1 through 8 of the financial statements. The independent auditor's report is found on pages 1 through 4 of the financial statements. And the first two paragraphs is where you can find our opinion on the audited financial statements. And I am pleased to be able to present a clean, unmodified opinion on the city's financial statements. This is the highest level of assurance that we can provide. And this is based on the testing that we performed in accordance with generally accepted auditing standards and governmental auditing standards. I will highlight there is one paragraph that is related to a change in accounting principle. There was an implementation of an accounting principle which affected the fiscal year ended December 31st, 2022, and that was the implementation of GASB statement number 87, which changed how leases were accounted for. So there's some additional calculations that were needed and testing that was needed to implement that GASB pronouncement, and there's some changes in the footnote disclosures associated with the implementation of that. However, as is noted in this paragraph, our opinion was not modified due to the implementation of this GASB pronouncement. Following
Can
the
you tell us
independent auditors.
what the net effect of that was? And what drove the decision to change that?
So the decision to change that is in line with GASB. So the Government Accounting Standards Board determines the accounting principles and standards, and this was in line with FASB. So with the public sector, change in how leases are calculated. So GASB and FASB presentation is pretty much in line in terms of how leases are accounted for. In terms of the net impact, there is a very minimal impact to the balances themselves. The change really is how leases are presented. So the impact on the city was more related to from a lessor standpoint. So any agreements or contracts that the city has where there's a collection of rental income or lease type income for leasing of space, a right to use city space. There is a long-term asset associated with that over the length of the contract term, and that's offset by a liability, which is due to the length of the contract. So in a net impact is really minor. Really, it's the balances, the way the presentation is in the financial statements to show the long-term receivable, and that's offset by a long-term liability.
Okay, thank you.
Can I just add one thing? There's been a lot of discussion, especially on the private side, but now it's on the public side, that this standard created a tremendous amount of work for not a lot of net change. It is really just a balance sheet gross up of assets and liabilities with very little impact on underlying reported financial results, but it does take an enormous amount of work without really changing, a whole lot in terms of the results of operations or the underlying economics. So I'm sure you spent a ton of work on this, Hitesh.
It will be more next year when we do what they call a IT subscription base, and we account for bills, and there's like hundreds of agreements. We have to come up with the same thing as what we did. And again, the impact will be minimal, but the time, effort for the accounting, finance, IT staff and others could be a lot more.
Yeah, but I would say this change probably had absolutely no impact on like the general fund balances that we talk about all the time, and the really the statement of operations. It's really just a balance sheet presentation that is a new asset and a new liability, pretty much. So, all right, sorry, go ahead.
Following the independent auditor's report, you'll find on pages 5 through 6 is the independent auditor's report on internal control over financial reporting and compliance and other matters. This is what we call our GAGAS opinion. So due to the level of grant activity the city has, we are required to issue an opinion in accordance with governmental auditing standards. And if we had any significant deficiencies or material weaknesses to disclose, that would be included in this section of the report. However, I'm pleased to note there were no material weaknesses and no significant deficiencies that arose during our audit testing. So there is nothing of that nature to disclose in this section here. And I will jump to just some highlights from the city's governmental and proprietary fund financial statements. So the governmental fund financial statements, beginning on page 11, on 11 and 12, you'll find the balance sheet for the city's governmental funds presented for each of the city's major funds individually and the total non-major governmental funds in aggregate. There's a lot more detailed information on the balances of these funds later on in the report, especially the non-major governmental funds. You'll find each individual fund's balance sheet towards the back of the report. This is in line with our opinion unit. So we issue an opinion on each individual major fund and the non-major funds in total. The general funds fund balance for the fiscal year ended December 31st, 2022 was at 61 million. Of that, 57.6 million was unassigned, and that unassigned fund balance of the general fund covers roughly 49% of the fiscal year's general fund expenditures, meaning so that that unassigned fund balance is the portion of fund balance the city has to fund future fiscal year operations. So that's roughly 49% of the fiscal year expenditures in that general fund. Proprietary fund financial statements begin on page 16. This is where you'll find the information on the city's enterprise, water fund, sewer fund, solid waste fund, motor vehicle parking system fund, coming to a total column, and that total is what's presented in the entity-wide financial statements. You'll find on the statement of net position for the proprietary funds, the net position for each of those funds listed, and the statement of revenues, expenses, and changes in net position, which is on page 18. You can see that for the total enterprise funds, there was an increase in net position over the prior fiscal year of 8.3 million. Something that might have come up in your review of the report is the negative investment income that is reported for the water fund and the sewer fund. And this is strictly due to a presentation of the negative change to the market value of certain investments the city holds in those funds. So the interest income itself was actually over 200% in the water fund and 348% in the sewer fund, which is in line with for the fiscal year interest rates and earnings. But due to the unrealized loss on certain investments that are held within those funds, those are presented in total. So that's what led to the negative investment income, and that's reported in the financial statements. So that's just due to a netting of the interest income along with the change in unrealized gains and losses for investments that are being held. And as I noted, GASB 87 resulted in some minimal impact to the actual change in that position or change in fund balances of the funds, but there were some additional footnote disclosures which disclose the individual lessor agreements the city has in place that are associated with those leases. I can open it up to any questions at this point.
So does anybody have any questions? I have a few, but if other people want to go first, please go ahead.
I just have a question. Is this, usually we have an audit, I think earlier, no? This was sort of late for an audit? And why did we have such a late audit this year?
Yeah, so it was the GASB 87 implementation resulted in a lot of additional testing and data gathering. With it being the first year of implementation, what was required was to obtain a listing of all of the potential lease or lease type agreements the city has, make sure that we understood every single amendment to those contracts and determine what the impact was to the city, and then calculate the net present value of those individual contracts to come to ultimately what resulted in the presentation in the financial statements. So that was a pretty significant undertaking this year, which aside from the GASB 87 implementation, the financial statements would have been issued prior to the June 30th date that we target. It was all related to the GASB 87 implementation and data gathering and calculations that led to a later issuance.
Okay, thank you. And that's a state? I mean, how does that get, who mandates that?
That's in order for the city to be in compliance with GASB pronouncements. So generally accepted government auditing standards board. those are issued annually, pronouncements related to proper financial statement, presentation of financial statements.
But, I mean, but this is the first time? I'm just trying to understand
So this applies not just to Evanston, but every municipality everywhere in the country.
Yes. And this is the year that the pronouncement was due to be implemented.
on all cities this year? Okay. So all
For
cities are
fiscal
late
years
with
ending
their
December
audits.
31st, 2022, correct?
Okay, thank you.
Anybody else have any questions? So just a couple points, if there aren't any others. I thought that the letter and the MD&A were very good. It really highlights that we've had this very unusual period of, if you think about 2019, everything was sort of in balance. You know, the fund balance was at the target, the overall results of the general fund were in balance, and then we had all this inflation, all this unusual revenue come through over a couple of year period, and you can see that sort of just working its way through the financials over successive years, ending in the year of really high inflation. And now I think particularly when we get into this budget cycle, we are searching for what is our new baseline? How do we get back to a baseline that is close to balance, because we've had this sort of impact of high expenses and impact of unusual revenues. So I thought that letter was good. One thing we don't mention in the MD&A is the adoption of our new pension funding policy, and I think especially if we're trying to highlight that to the rating agencies, it's not in there. It might be because we adopted it later, but that was just one thought about should there have been a comment in the MD&A relative to the adoption of the new, pension funding policy, and what would be our plan to communicate that. Maybe we do that next year, since that's really the first year. But that was really relative to the letter in the MD&A.
I would just touch on the things. Yes, obviously, we were done with everything before the June 30th.
Yeah.
Except this lease portion. And the other thing is communicating with the rating agencies. We always bring up these things in our call, as well as they submit us questions, some of those things. And then we clarify that, okay, this is what happened, And obviously pensions, along with the debt, are some of the big things. General fund balance is the other one. They always look at these 3 or 4 items. So we do talk about those.
So you'll highlight that then,
Yes.
and then maybe we could put that in the MD&A
And then
next
we
year.
get a chance in our presentation, we get an hour-long kind of a Zoom meeting with them, and that's where we do our presentation to talk about those highlights.
Okay, great. I did, our page 39 of the PDF does mention that we paid down GO debt of $11.2 million in '22. I think we'll talk later about how much debt we have paid down. This sort of goes to the point of when we ask for new debt, let's also keep in mind we've paid off a lot of debt, and sort of is the direction good in terms of debt pay down? But that's in the page 39 of the PDF report. Question I had on the balance sheet on page 42, we mentioned loans of $9.8 million and due from other governments of 12. I just wanted to get a little bit of context for the group about who owes us money, what's the general nature of that? Do you have any collectability sort of thoughts? I don't think you do, but just maybe for the group, we have receivables of, about $20 million, and sort of what, any concerns or thoughts on that?
Thank you, Chair, and the members again. Yes, so those are the legitimate and genuine receivables. We will get the money back. The $11 million you see due from other government is the money where the sales tax, income tax, and those money which belong to either October, November, or December of the year, but comes after the year end. Obviously, sales tax and home rule sales tax would be the big one, which is a 3-month lag. Okay. Income tax is only 1 month, so it's a small amount. So that $11.2 million is all the money due from the state government.
Yeah.
The other loans are in our department, in the funds like CDBG, home, affordable housing, and all those loans. And Some of those loans are forgivable, so we are depending on certain conditions. Once they meet that condition, every year we forgive some. Some of those are loans, and they have a payment schedule, and we get the money back.
Okay. But the amounts are not unusual in any way and well reconciled. Okay. And then I think for the overall group, since we have been so focused on pensions, just looking at the note, which is a lot. So the pension funding ratio for police ended up at 54%, down from 68. That's kind of, we talked about that, and that was to be expected given the rates of return on the assets last year. Fire ended at 47, down from 58. So combined basis, the public safety pensions ended 22 at 51% funded, down from 64. And some of that will recover this year, at least given how the markets have reacted. I think still, though, there's been a degree of bond sell-off this year, so it's still going to be, it'll probably be a couple of years before we get back to the 68% for police and as we move for both of them towards hopefully or towards 100% by 2040. But there's still, it'll take a while to dig out of the hole caused by the market returns that happened in 22. And just one other point, and then Councilmember Kelly, I'll come to you. One thing that did stick out to me though is that, Fire has consolidated their assets. They did that in approximately 22 or so. Yeah, into the state plan. And so, which is good. I'll say that, their negative return was about 15% last year. But police, which has not consolidated their assets yet, their return was about negative 16.8, so almost 2% worse. It's not a complete apples-to-apples comparison because I don't have the number of what the state consolidated police fund recovered. I would assume it's something in the area of what the consolidated fire, but I think this is another area where there's been litigation and other things, but I think there's benefit. It's not up to us, it's up to the pension board, but there's been litigation to comply with state law, and it would be good. I think the sooner the better that the police pension assets get consolidated into the state plan, because a 2% worse performance for police than fire is significant on their asset base of about around $150 million or so. So, at any rate, this has to work its way through the courts, but certainly some police boards have already consolidated. Fire across the state was much quicker to consolidate. And if you just want to look at a big down year, and it could be because it's just the state pool is a little bit more conservative, the consolidated fire returns were about 1.9% less bad than the police. And I think that's something we want to look at further about how to, what is the benefit and what should be, how do we want to try to talk more to the police pension board. It is an odd situation that we're responsible for the funding, but not actually the direction of the assets. But that is how the boards are set up. That the city is only 2 of the 5 votes. But at any rate, I think it's something we need to discuss with the police board a bit more of what is their plans and what do they see as the ongoing benefits of not consolidating, especially when it's been through 2 layers of litigation at this point, and what would be the timing of the consolidation. So that's sort of what I had. I think a ton of work gone in here. So Councilmember Kelly, you had a question?
I was just going to add, since we're on the pension topic, I think in the past the police had been doing very well. I think it's just you're comparing it now to the consolidation, so that is an interesting question. I also think we have to look at, I would ask that we get going forward, the rate of assumption, that we get a projection on the rate of assumption, because what we also want to make sure is, well, clearly if we weren't 100% funding, that increase would be even more, so at least we're slowing that down, stopping the bleeding there. But I think we do need to get an accounting from Jason of the 6.25 versus 6.5 projecting forward, whether that will in fact be decreasing our debt. So I think we need an accounting of that.
Okay. Yes, and there were years, in fact, the year before, fire did better. So they have been years. And it does look like, I went back 6 years, it looks like in a down year. Of course, the problem is fire wasn't consolidated until 22. So at any rate, how do we, why are we not consolidated, I think? And where's the litigation going, and what's the timing and all, and all that? But
Could we ask maybe Police Pension Board President to come and to our next meeting to answer questions?
we could consider, is it that one or a future one? Yeah, we could. We could ask them to, come and explain what's their justification. He did mention in some prior public comments some transitional rules and other things, but I would like to understand and maybe get Jack's view on why fire was relatively quick to consolidate.
Yeah, I think
So,
that would be good.
But again, I think the state set up a group of experts that presumably have access to different asset classes than we do, which should be able to provide a better long-term return at a lower cost. That was one of the justifications for the consolidated plans was it's got to be more efficient when you're managing billions of dollars of assets than hundreds of millions, even though it's a big number, and the expertise for that. So, at any rate, I think with that, I mean, if we want to have a vote on accepting the annual report, I think is our next.
I'll make
next
a
step.
motion that we accept the annual report and recommend acceptance to the council.
Councilmember Kelly.
Aye.
Committee Member McMillan.
Aye.
Councilmember Nguyen. Councilmember Nuzma.
Aye.
And Chair Livingston.
Aye. Good. All right. So now, moving on to sort of a mid-year financial update on where we're currently seeing the projections for the general fund for the city.
Okay, so this is a report that we provided in August of last year, and we are here again with this year's mid-year summary. This screen just kind of summarizes where we were at through the end of June. We do have another month of actuals, but we figure June is a good month to look at since it's the halfway point of the fiscal year. Through June, we were at 52% of revenues, 54% of expenses for a net loss of $2.5 million. This is the good news. So our fund balance is sitting at a very healthy $55.3 million, very close to the number that Martha said from the audit report, where we finished with the fund balance last year. Oh, it walked off. And then that $55 million is 43% of our budgeted expenditures. So in terms of revenues, just focusing primarily on those, I know we talked about those in May, and we're here with a bit of an update on some of those. Most of the shared state revenues are trending where they were in 22 and even a little higher. Sales taxes and home rule sales taxes continuing to be impacted by inflation, continuing to do really well. Both are up 3 to 4% over last year's numbers. So they're on their way to topping last year's record high, which is great news. Income taxes are one, however, that are actually down 7%. These are set by the state, and so we're a little surprised. They are trailing a little bit below IML projections at 7% down. But the good news is they're still tracking the budget. They're just not tracking over budget. PPRT, so we talked last year a lot about this one, and it's part of our pension policy, highlighting the volatility of this revenue and some of this actions taken by the state in their most recent budget. IML's most recent projections have them projecting a 29% decrease to PPRT for July 23 through June 24. And our returns thus far down 17% compared to last year. Still on track to top what our budgeted level was, and we'll highlight our projections for these revenues on the very next slide. But they are trailing our 22 actuals at the same time last year. Yes, thanks for doing the math there, yeah. So
Quick- How much have we, to date, what have we collected?
I don't have the number in my, well, I might have it here in this presentation. On the next slide. One, 1.9 million?
So, okay, so I just want to check because I see 2.8 million. In the,
2.8.
and from the state, from the Illinois Department of Revenue, it shows that they've already issued 2.8 million to the city, which we budgeted 2.85 million. So we're almost at the full amount that we budgeted, so we're going to exceed. It's clear
Well,
that we're
and
going to
let me
exceed. We
ask
have 3
too-
more payments remaining. We've had 5 of the 8 paid already.
Let me ask too, in looking at that data, are you counting the amount that was received in January of 23?
I know that January, that it's from December.
not
No,
counting
I'm
that in
counting
your
the
number?
8 payments for this year, not the January payment, which is, I understand is for the previous year, but I think we've received 5 of the 8 payments, and we're already at 2.8.
These numbers are as of
Okay, but
August
we're
11th, according to
we're
the
almost in
table.
September. I mean, okay. Right, but I think it's important to note that I think we're at 2.8 million, and we budgeted 2.85,
Correct.
so
No, so
we
our
have 3
projection does
payments
have us getting,
remaining.
our low end of our projection has us getting to 4 million. So we,
Right, so
we
we're
know
gonna
we're going to
exceed.
exceed the
We're
budgeted
going to exceed
amount.
the budget amount.
Yeah,
Okay.
absolutely. And it's possible too, this doesn't include the 605,000 that goes to pensions. I'm sorry, I don't know if that's included in this number or not. I'd have to check the numbers behind the table. My mouse is deceiving me here. So, but we do know it's volatile, and we do know they're projecting a very large decrease moving forward that we'll have to keep an eye on, and since it's a key part of our pension policy and how much we're able to pay out of PPRT.
That's for 2023,
Yes.
right? We haven't yet talked about 2024. That number could go
The
up.
projection that they've provided to us of a 29% decrease is for, what they're saying is, the amount we received from June 22 through July 23 is projected to decrease by 29% for July 23 through June 24, based
Got it.
on their fiscal year.
But I think we need to understand, we way under budgeted for the last several years tremendously. And I can give you those amounts. We budgeted in '22, 1.2 million, but we came home with 5.5 million. So let's be clear, when we're talking about a decrease, that's a decrease from 5.5 million. For this year, we budgeted 2.8 million, and we're already collected 2.8 million. So be clear, there is a decrease. Originally, it was a 33%. They've adjusted now to a 29% decrease. We're still going to come out way ahead. Probably, we have 3 more payments remaining, so.
Absolutely. I
we
guess
keep
I
an
would
eye on
just
how much
highlight
surplus we'll have.
that a 29% decrease to a major revenue is not the kind of trends you see with most of our revenues. Sales taxes are up 3, home rule sales taxes are up 4. I'm just highlighting the fact that it's a very volatile revenue because it's set by the state. And if it goes up one year, they tend to take note of that and then shift part of that over here. So what we probably will continue to see that moving forward. Real estate transfer taxes, unfortunately coming nowhere close to last year's record highs. We've seen the high interest rates in the housing market really impacting this. Midway through the year, they're down 29%. We do think that the reparations fund will get the $3 million that per the budget was allocated to that fund, and so we do think that'll happen. And we will probably get the $3.75 million that we budgeted, but we would need some major large sales here towards the end of the year to exceed our budget of $3.75 million on that one. And then several local revenues on pace to meet or exceed budget. These include recreation program fees. We raised our fees last year. We're continuing to see a lot of participation. Building permits is down quite a bit compared to last year, but it's still expected to meet budget. There were a couple really large permits issued towards the end of last year that really impacted that final number. We haven't quite seen that. There's a lot of big projects in the hopper that could come in, but this is, again, a pretty volatile one. Ticket fines, GEMT, and ambulance revenue are all on pace to exceed or meet budget as well. So this is our low projection that we're offering and our high projection that we're offering on revenues based on the stuff I said on the last slide. On the low end, we think we'll exceed budget by $10 million. And on the high end, in terms of revenues, we could see $13.3 million in upside. So that's the good news. Again, the inflation is continuing to carry these numbers. We haven't seen the recession that we were a little concerned about happening, so revenues are continuing to do really well. And we've got a low and a high end to kind of cover a $3 million variance on a few of these. In terms of how we've used the $10 million in revenue, so if you'll remember, our budget that we passed had a budgeted deficit of $10 million, which means basically with $10 million in upside, we're a wash, which means we start from kind of a balanced budget with the upside in revenues. However, this year, there's been a few things that have been approved by City Council that have increased the amount of expenses that we're expecting. These include covering overages on a handful of capital improvement projects, as well as much higher than budgeted wage increases in the police and fire departments, with police at 17% and fire at 11% wage increases. Compared to our budgeted 4.5%, we saw some pretty significant increases there. And then we aren't in a position yet with AFSCME. I think the City Council will be continuing to weigh in there soon, but we'll definitely see a contract that results in higher than what we had budgeted with them. And in speaking with City Manager Stowe, there's likely to follow a non-union wage increase that could be considered as well, just given the volume of wage increases that police, fire, and union and AFSCME have seen.
Councilmember Kelly, would you like to go first? I had a comment as well.
No, I'm sorry. I didn't mean to, sorry.
Going back to when the budget was set, I think we discussed at the time that there likely was some upside, in particularly the sales tax numbers that were being used, and potentially some other areas. But the offset to that at the time, and was brought up at the time, was big potential uncertainty relative to the three major union contracts that were all up. So that is somewhat played out, the way I think that we'll get to your new projection in a minute, but we are roughly within the bounds of that original budget, sort of knowing going in could be some upside on revenues, and likely would be some downside relative, particularly wages,
Right.
With respect to the contract renegotiations, or negotiations, not renegotiations. Okay, thank you.
Absolutely. And so the 6.6 million here has been approved. We know more is coming. These are some of the items we've talked about with this committee over the last several months, increasing our fund balance policy, helping out two funds that are have a negative fund balance, the insurance fund and parking fund, as well as overages on future CIP projects. So we're just continuing to keep these in front of you as items that we have talked about. So now looking at this slide, this shows you the low revenue projection and the high revenue projection, including those items that were on the last couple slides. So the middle column here is the low projection, and the arrow is kind of indicating where we're projecting to finish the year. From a low end on revenues, we would expect to finish with a fund balance of about 49 million, with a net deficit of 8.7 million against our budgeted 10 million, which, to the chair's point, is kind of like we're landing pretty close to where we said we were going to land. On the high end, we could see a net deficit of just 5.4 million and finish with a fund balance of $52 million, which both of those are well over the fund balance policy.
16.6% is what we're
Correct.
currently defined in that policy, yes. Got it, okay.
So this would be considered the excess reserves here in this first line where I'm pointing. The bottom line is just if we were to do the 15 million on the last slide, what that would do to the fund balance. Anybody have any questions on this slide? Because I know there's a lot of numbers.
This goes to the bond point as well, and I think on the incremental general fund items that you have, the sort of the offset to not issuing bonds is it's got to come out of the general fund, and we'll use up the excess reserves faster. So, but I think the key is to get to the next couple of pages where, again, these are very, if we look on, we'll get there.
Yeah.
The deficits that are shown for preliminary 24 and 25, I would say cannot happen, right? We have to say what's the work we need to do to make sure that those don't happen to that degree. So I think, again, we're getting to what's the new baseline budget and how do we get to something that's stable after we've worked through all these over the last couple of years, incremental revenues and incremental expenses and new union contracts. So, Councilmember Kelly?
I think it's also really important. I know the general fund is the largest one with the 16.6, but we have 11 funds with reserve balances, and that also many of them have surplus or excess funds above and beyond that. So I think at some point we really need, is that here?
We have those in the following slides that'll follow, so we can go through
Okay,
those other
great.
fund balances and show them against their policies.
I think a lot of folks don't realize that we have that all, 11 funds, and some vary from 16.6 all the way up to a 25% reserve fund balance. Okay, thank you.
Councilmember Newsma?
Thank you. I just want to confirm that the projections we're looking at on this slide reflect 100% funding of our pension obligations.
Yeah, so this is what we, that was included in the budgeted deficit you see there for FY '23. That's why we had a budgeted deficit we approved using $4.5 million, I think it was, from reserves to pay for the 100% this year.
For this year?
Yep.
Okay, thank you.
All right, so this is the good news, and I mean, it is really great news. We've had a couple really great years with revenues that have been doing really, really well, but as we've started this year's budget process, we wanted to call to your attention some issues that are definitely major concerns going into this budget process that we'll have to sort through as the chair identified. So revenues have likely peaked. We've already seen a couple of the good ones, like the real estate transfer tax, start to taper back down. It's a reality. Inflation is back down to, I think, 3% over the last 12 months, so we're not seeing those go up much further. Contractual and non-union wage increases, we've approved more than $10 million in increases to salaries this year compared to our '23 budget, given the approved contracts. It's a huge number. It's something that is definitely playing into the numbers as we've started to look at what '24 looks like, and we'll have to figure out how we can sustain that level of increase moving forward, since they're contractually obligated and they're increases that we're obligated to pay for. In terms of the pension policy, I meant to change this, but under the new policy, based on the most recent numbers we've received, $5 million of additional contributions will come from sources that were previously allocated to the general fund. So PPRT, under this new policy, that's $5 million that has now been set aside for pension, to cover our pension policy, our pension obligations at 100%.
Not 6.6, 5 million.
5 million.
correct.
Based on the most recent numbers from our actuary, we're looking at about a $5 million increase here.
And I just, that's very misleading to put volatility of PPRT and projected 29% reduction, when in fact we're already on course to come in with well over what we budgeted. I mean, that makes it look like, oh, we're going to take a hit, when in fact we're not. We're going to come out way ahead. So I would ask that you remove that. There is a reduction, but we have, like I said, routinely way under budgeted, including this year. We're almost at what we budgeted right now with 3 more payments left. So that is making people believe that we're going to come in under, when in fact we're going to come out well over what we budgeted.
It is down year to year, right? We're exceeding budget.
It's 29% below the 5 million that we saw last year, which means it's less money for the pensions, which means more pension contributions would then have to come from the reserve fund balance.
I don't know if
I
folks
kinda-
understand this, though. I just want to be clear, like, we budgeted last year 1.2 million, right? But we ended up with 5.5. So this year, we budgeted 2.8, and we're already at 2.8. In other words, we could have budgeted more. I mean, it's fine that we don't, but I want to be clear that this suggests that we're going to be coming in under or with less, when in fact we're going to, we still under budgeted, is my
We're
point.
more than budget, but less than last year, I think is the answer. And talking with some other communities as well, PPRT, everyone's frustrated by an inability to know what the state is going to pay. So it's very volatile. Part of it caused by the fact that they're on a different fiscal year. So it's hard to even
So
understand.
it is somewhat, but there are projections, and we haven't been following them. So for example, from year 2019 to year 21, there was a projection that it would be about, that it would triple, but we never increased ours. We stayed the same. So you can there are ballpark, the IML does projections, the IDOR does projections, but we have traditionally, it's been problematic, so what we've ended up doing is way under budgeting, as you can see, like last year. This year, we're doing better. We'll be closer. We'll still come out, we're still under budgeting, but you can, IML and the IDOR do give some ballpark projections.
No doubt we should be better. We should be better. We would want to be better. we want to be better.
But
and
given
have
the
better info on
volatility
PPRT.
of that number, there's no way to accurately predict what it is going to be. There's some guidance, but you still never know. The prudent thing to do is to under budget, so we don't find ourselves trying to make up money after the fact. And
But not by 4 million or 3 million. When you don't, we were just giving the same amount, it was 1.2, 1.2.
So, I mean, to the extent possible, we can, take whatever guidance into account and make a logical projection. Let's do that. But if it's going to be volatile,
For this
err on the side
year's-
of caution
I'm sorry.
and under budget.
I'm sorry. For this year's budget, we will budget a 29% reduction from the actual amount that we receive. That's based on IML guidance. We'll true it up with what we've received, and that'll be our budget for next year that we recommend for.
And I think it would be good to present for this committee the number you're proposing to go with for PPRT and why, so we can all understand what's been the recent trend.
Right.
And if you're recommending a budget of 4 or whatever, why you think that's the right number, and we can have people ask questions and see if there's any other data that anybody has that would indicate that a different number should be being used for
But-
PPRT.
And fortunately, we have a pension funding policy now in place that says if PPRT comes in more than budget, that's where we go first to fund our pension
It all
obligation.
goes towards pension.
Right.
Our funding policy says 100% goes to pension.
Right.
And I agree, but always our basis should be based on actual, what we received, so for example, when there was going to be, when it was going to double and we collected, say it was from 20 to 21, if it was going to double, if the projections were doubling, then we should have, if we collected 1.5. At least, again, I agree with leaving room under budgeting, but it should be based on what we collect, what the actual amount is versus basing it on what we budgeted.
We'll true up our budget, and I definitely don't want to lose sight of the major point of the slide too, that whatever we get from PPRT was general fund, now it's pensions, and that creates a hole in the general fund that then has to be filled. Whatever the PPRT amount is, whether it's 4 or 5 million, it's a hole that the general fund will have to work through as part of this budget cycle. The capital improvement plan, we'll talk about that later. Equipment replacement plans, so this is a big one. ARPA has helped subsidize the equipment replacement plan for 2 years, but ARPA is unfortunately running up soon. It's nearly all allocated, which means the general fund will have to take this responsibility back over, and we're looking at a magnitude of about $2 million that the general fund has not had to fund for the last couple of years that it'll have to take back on. And then in terms of staffing, we budgeted a 4% vacancy rate last year. We're starting to fill a lot of positions across the city, so we're probably doing okay with about a 4% vacancy rate, and it's something that we can consider carrying into next year's budget. But we are starting to fill some positions, and so as part of this budget, we'll just have to take a look at what the most appropriate number is based on our vacancies. And then finally, in terms of staffing, there's a number of new positions under consideration, both that support city council initiatives, things that the city council has wanted to advance, members of the city council, and those are under consideration by CMO. So ultimately, this slide comes out to about $20 million in additional general fund obligations that weren't included in last year's budget, between the salaries, the $5 million in PPRT pension money that was previously allocated towards the general fund and is now being shifted there, the equipment, the $2 million that the general fund has to pick up as well. So it's a pretty big undertaking, and we're starting to see this is the expenses catching up with the revenues that we had talked about.
But I would say some of the revenue good news will carry over, right? Like sales. I mean, absent a recession, right? Okay, recession happens, everything, But some of the good revenue news does carry over to offset some of this. We have a higher baseline with respect to certain revenue streams that have benefited from the inflation.
Definitely.
There's a bit of a natural offset there.
And speaking of the 4% vacancy, do we have a projected surplus for staffing?
It's part of this number on this slide. So this includes our projections related to staffing. I mean, unfortunately, while we budgeted a 4% vacancy rate, we also budgeted a 4.5% wage increase, which dramatically was under where we ended up landing on that. So we're not going to see the savings from positions because we're seeing the overages on the wage increase side.
So what is the savings from positions? I'm sorry, am I looking at it? Where is the projected savings from positions?
I mean, I mean, it's baked into this larger general fund number. There's no savings from vacant positions because the wage increases.
No, I'm not, I just want to know, based on the people that haven't been employed that we budgeted for, what that amount is. I would like to see that number, or the projected, right? Because I understand we're filling positions too, so it's not going to be
Sure.
the entire year, but a lot of people have also left, and so those positions have opened up, and so what the total is, and then we can also look at what the salary increases are, but it would be good to see that broken out.
We'll bring that as part of the budget, unfortunately. It's not an easy number to reconcile really fast because all of our salaries are all in the regular pay account, which means you can't differentiate between the positions that are vacant and the savings from those versus, we can see what we can put together
Thank you.
on it. But at the end of the day, we're paying more in salaries and wages than budgeted because of the wage increases by a significant amount. We think, and that's what this is in police and fire. So fire is looking at going over budget by 1.4 million on salaries. Police is going to go over budget by 1.6 million on salaries. AFSCME is going to go over budget by whatever that it comes out to. So.
But front-loaded contract, right?
Right.
Jump for 2024 this year, smaller
But it's-
increments of funds.
Smaller increments in future years, but we still have to pick up the big number that we.
And Clayton, if you go back to that prior slide, some of those items are non-repeat, the ones where you had the unusual items, where the wage increases just were. The slide you were just on.
Oh, sorry.
You just went over it again. Boom. Right there. I mean, the animal shelter project, that's non-repeat, right? Skate park, I guess we could have other capital projects that run over, but some of what the general fund has had to absorb in the current year might be replaced by other overages, but these individual items do not repeat.
Right.
So,
Just the wage increases.
good. I think you had a normal amount of unfavorable news during the year, that the budget had enough flexibility that we're kind of landing where we roughly thought. And some of that always happens. But there is some base cost in the general fund this year that is non-repeat. Could be repeated by other things, similar things.
Right.
But some of those items do not create a new base level for the next year.
I had LASIK surgery over the weekend, and I cannot find my mouse on this.
Oh, okay.
Sorry about that. So this is, Councilmember Kelly, I'm sorry, was there anything else on general fund before we kind of go into the other funds? Okay, so this is a summary of the other 31 or so city funds. Over the next 3 slides, we've indicated in the far right 2 columns what the required fund balance policy says for that fund, as well as the excess or deficit within the fund compared to its fund balance. So looking at this first slide, there's only one of these funds that has a reserve fund balance policy. That's the motor fuel tax fund. It has a reserve balance policy of 16.66%, but this fund is highly restricted by the state as to how we can and can't use any excess reserves within this fund.
It says page 10. Is this, we're off by one? Okay.
Sorry about that.
And I know, I mean, in the past, again, I would highlight the fact about the MFT restrictions. We have been working with the IDOT auditor for last 3 months, and they go into the individual payroll details and individual. So yeah, there's no room that we can just kind of, hide anything. We have to be transparent. They ask for check register, bank statement, general ledgers, every minute detail. And we have been working with the IDOT auditors for almost last 2 or 3 months. So it is restricted in terms of where we can use the fund, and that's where we have extra funds. And again, Lara can touch on it later on, that yeah, she has the projects lined up to be funded out of the motor fuel fund in the next couple of years.
And I'm sorry, is that on here, motor fuel
Yeah.
tax? Yeah, so where do we stand to date in terms of,
We have a fund balance of 6.2 million, which the required fund balance there is 1 million, which means we have about 5.2 million in excess in that fund
to date?
today.
And what's expected, do you have a projection by year end?
Laura has, given that this money can be used for resurfacing projects, you're asking about year end. Sorry. It'll probably end with close to that amount of
With
excess
close
reserve.
to,
Close to the 6.2. I mean, I'll
so
let Laura
that's
respond
what
to
I'll
that
be
point.
really looking for this year is a much closer projection than what we have ever gotten in the past with regard to unassigned funds in each of these funds, including the motor fuel tax. So we're right now at 5 million in over the 25% reserve. We're in 5 million over that. Okay, thank you. So we have and the 25% reserve represents how much of the motor fuel? Sorry, not.
1 million.
So 1 million, okay.
But the motor fuel tax could not be used to offset general fund expenses, right? It can
No.
only be used for certain things.
100% not. It
So-
can be used for street resurfacing and other infrastructure projects in the right-of-way, but pretty much street resurfacing or lighting, potentially sidewalks, if they are designed exactly according to the statewide IDOT standards. IDOT reviews every drawing set that we want to use MFT funds on to make sure it complies with their standards. It can also be used for salt purchases, some very specific road maintenance purchases. However, we are trying to move more towards contracts and salt because as we were finding when we were trying to do salaries out of MFT to offset some of the general fund expenses, the accounting for that is so onerous that it is not worth it. So we are moving things around in 2024 to try to make it easier, the accounting side on our end, a little bit easier and more straightforward, while spending down the 5.2 million on some capital projects.
Also pictured here are a number of other city funds. These don't have reserve balance policies, but they're for things that the city council has deemed important. Things like the reparations fund, the sustainability fund, the good neighbor fund's got some strings attached to it, but the affordable housing fund, these are all funds where you can move that money. It's not restricted. It's only in these funds because the city council has directed staff to maintain these funds and advance the goals and priorities within those areas. You also see the large ARPA cash balance. So anytime you look at our investment reports that we put out every quarter and you see that large cash balance, a big portion of that is the ARPA cash balance that's on hand and has been assigned to projects but is slowly dwindling as we complete work on those projects. There we go. Debt service funds, I can't even come close to reading this. It's in your packet. Page 10 of the presentation in your packet. You can see these are the debt service funds. Chief among them is our main debt service fund where we pay towards debt service principal and interest obligations on our GO bonds that we issue. You can see our TIF funds pictured here and the fund balances with those. I think in most of the instances, the current fund balance is less than the amount of outstanding principal and interest that we have within those TIF districts. And again, these are regulated by the state. In the state, you can't move this money out of here and put it in the general fund to pay for general fund operations unless there's some tie to the TIF itself. So we do already pay a portion of our economic development director's salary and some of the finance folks out of these TIF funds. We already kind of take advantage of that to its fullest potential, but not much wiggle room beyond. Most of it's for infrastructure projects that come through the CIP. This is our capital project funds, our enterprise funds, and our internal service funds. This is slide 11 of your attachment. You can see the capital improvement fund and the impact. You have the large cash balance of about 9.5 million compared to the fund balance of 3 million. Again, that difference is due to the outstanding obligations we have to IDOT. They bill very slow, and that's why we have more cash on hand than we do within our fund balance. In the enterprise funds, we've talked about parking and we've talked about insurance and the fact that those are below their fund balance policies. One fund that is a bit over its fund balance reserve policy is the sewer fund. It has a required fund balance there of 1 point something, and it's got an excess balance of 5.2 million. So it's probably one of those funds that has built up a pretty decent surplus within it as well. But you can see solid waste and water are both right on what their required fund balance policy says that they should have in reserve.
So is that excess sewer fund available for some of the capital projects on the sewer system that were,
I will let Laura.
yeah? Maybe it's a separate, right?
So my name is Laura Biggs. Sorry, I should have announced that the last time I spoke. Yes, the sewer fund is available, and we do direct it towards capital projects. But the other thing that happens with the sewer fund is over time, as the cash balance is built up, we've actually reduced the sewer rates to offset water rate increases to create negative or neutral changes to the water bill. We're not going to be able to continue to do it with the magnitude of water costs that are starting to hit the water fund. But for the last several years, we've managed water rate increases by reducing how much we collect for the sewer fund.
And do you have a projection again for that? So we're at 6.5 exceeding the 16.6 reserve. Do you have any projections by year end where that might be? That 6.2?
I don't have them off the top of my head, but I'm sure we could. I'm sure we can develop that information.
I just think it'll be much more transparent and helpful for everybody when we're trying to figure out the budget for '24 to have those numbers, as well as when considering issuing bonds.
Within the budget, that is a page in the budget that we'll make sure we include with those. As part of the budget process, as we take in next year's requests, we review where we're at year to date. This is where we're at year to date. We've got 6 more months. We project that out as part of budget and make sure that's a page in the budget so you can see where we project to finish the year end.
There are, twice a year, there are 2 big hits that happen to the sewer fund. We entered into quite a lot of debt to pay off the long-range sewer program that occurred between 1990 and 2008. And most of that was through low-interest loans with the Illinois Environmental Protection Agency. So twice a year, debt service is due, and we are paying off those loans. But part of the reasons why we built up a fund and we're gradually reducing the sewer rate is because as more loans roll off, then we have less obligations on the sewer fund. And I would just finish by saying the sewer fund can pay for sewer assets. So it's not like I can take that money and then use it to resurface a street or build a park. However, we do try to leverage it. Recently, when we had a change order for the animal shelter, there was a substantial cost that was due to stormwater detention, which is a sewer asset. So that type of thing, we can then leverage the sewer fund to help offset some of those costs to the general fund.
I think that generally ends the slides that I had for this presentation. So we're in a good spot now. We know they're.
Who's doing page 236 where we have the longer-term projections? Is that Hitesh or? Because I think this is the real.
That is, I think that's what's throwing off the numbering in my presentation, because it's not in the.
It's not in the.
I will need to go to the packet to open that. So.
Okay. But I think, this is the summary, page 236 of the packet that shows it's actually the low estimate on revenues. So a deficit of 8.7, 8.8. I think the high estimate was closer to 5.5, so maybe it's a little bit better. But then a preliminary view, and again, this can't be where we land. A preliminary view, the 24 would be in the area of a current year deficit of around 16.4 going to 20. So I think that's where our hard work is going to be. First of all, I think it's great. We didn't have this visibility, I don't think, before of a really discussed and thought out projection for the current year and what we think going into budget is going to happen for '24 and '25. So the good news is we have this visibility, and I think we have a lot more analytics behind what's actually going on and understanding on these individual line items of revenues and expenses. That being said, it would be, I think, difficult for us to, go into '24 thinking we had a deficit of 16. So whether it be, we'll get into the details of what are the assumptions relative to property or other taxes and sales taxes and whatever those might be. But we're going to have to find a way, I think, to do better than a final '24 budget that's negative 16 and an implied 25 of 20. Because if that's the case, then we will have over '24 and '25 eaten through all the reserves, all the excess reserves. And that's, the tough part.
Why-
That's something we can't do. That's the answer to Mary's question. The reserves would be used up in deficits in '24 and '25. And how do we make that not happen?
One more question. I'm just back to that chart. Why isn't there a required fund balance for the water fund? Because I thought that was a 16.6, the water fund.
I've closed that, but I believe there's a fund balance reserve shown in that table for the water fund.
Yeah, no, it's all there. I just wonder why there wasn't the required fund balance, like what that 16.6 would represent, why that space is blank.
The 16.6 would represent the 5.8 million that's shown in the second to last column. That's the
For
reserve.
the water, under enterprise funds?
Yes. It shows that the required
Oh, I'm sorry, I'm
balance.
sorry. Am I jumping? Oh, wait, one moment. I think it's the lines. I apologize. I see it now. So that's a significant also. So that's above and beyond the 16.6, correct?
It is above and beyond the 16.6, so the water fund is a pretty substantial business enterprise for the city of Evanston. We are essentially running a very large manufacturing process that has to completely pay for itself. And so as we have worked on rates, both for our wholesale customers and our retail customers here in town, we've worked with financial consultants at different times to make sure that we always are following the best national practices for how we set water fund. And the last consultant we hired did recommend, because of the volume of commitments that the water fund has, that we always maintain something more akin to a $5 million balance rather than just the 16.6%.
But I mean, that's not, we're budgeting for reserve. I mean, our taxpayers, we vote on a reserve on 16.6. We can't just sneak in. I mean, we can't just increase that without transparency. I mean, it sounds like what we're doing is just creating buffer. 5.8 million to say that we're intentionally creating excess reserves to 5.8 million. Then we just need to say we're increasing it from 16.6 to 20%. I mean, we can't. If that's what you're intentionally doing, is creating like this fund that appears to be like a hidden reserve fund, we can't have that. We need to increase it to a full-on 20 or whatever it is. But we can't just say, oh, we just think it's good to have excess beyond the 16.6.
That's actually something that we discussed in making sure that we're making it clear in our fund policy this year. At the time that that decision was made, it was fully reported to the city council as a result of having the cost of service study at that time. And somehow the narrative for the fund policy wasn't updated, and so it's something we've discussed making sure that we do.
And again, I mean, as Lara can throw the numbers, I mean, there's almost, 100 millions of CIP projects in the pipeline? Because the other day when Luke can say that when we directors visited and we heard from the water superintendent that, okay, I would need these, which would like a 50 years life, and we are out of that, might few millions here. So they have a lot of requirement, and considering that hundreds of millions of dollars, like we invested in sewer in last 20 years, over $200 million. You know, same way, I think we might see a big CIP infrastructure, investment in the next 5 to 10 years, and that would be, that could go up from 50, 80, 100 million. Yeah, Daryl can speak to more. Lara has some ideas, and so if you consider $5 million fund balance, that is one of the things. And I think even in '24, we have a few millions of, one of the big project is coming up. And
Right, but that has to be budgeted. And so you're saying that's not, that 5 million is excess. That's above and beyond the 16.6. Don't call it the reserve fund. We have, I mean, if I'm looking at these right, this is the amount that is, like, for example, for the water fund, the fund balance would be 6.7. It's budgeted at 16.6. We have above and beyond that of 5 million. If we want to increase the 16.6, then we need to just simply do that. And I think I've made my point. I don't want to perseverate, but I mean, we can't just, increase the amount above and beyond the reserve because something might come up that we're not, as a council, democratically deciding how we want to spend the money. So I just think we have to be clear on this. We don't just create reserves beyond our reserves because something might come up. Otherwise, it's not transparent to the residents what we're budgeting at year end for the subsequent year.
Okay, and I think Daryl, I think in the next Finance and Budget Committee, the water superintendent will go into the details about the potential requirement. And yes, we can have the direction from this committee as well as the council, whether we want to increase the fund balance or set aside at this level. Because some of the things with like some of the old infrastructure, even he said, I don't know, but if it breaks, and again, I don't want to speak on his behalf,
But then we budget appropriately. If we think we need to budget just like maintenance, we should have whatever necessary line items and we budget in, at the year's end for that. We don't just put away or, in addition to our reserve funds, a bunch more money because maybe something will come up because that also lends itself to a lack of budgetary discipline. So it's really important that we decide, okay, annually or, routinely we see these sort of expenses are coming up. We need to budget for it. We need to assign the money. Not just have surplus, excess, above and beyond our reserves that who knows what might, this isn't really fair to our taxpayers because then they aren't participating transparently in our budget process and understanding what we're budgeting.
I just wanted to clarify too, I think that there might be a slight misunderstanding, but the fund balance in the water fund is 6.7 million. Of that 6.7 million, 5.8 million of that is the reserve balance, which means we're only over our reserve by $919,000. So we're not sitting with 5 million above and beyond the policy. Within that 6.7 million, 5 of that is the reserve with 1 million
Understood.
of excess.
So I think those are the numbers though for each. So okay, so.
So the far right column
is
would
the
have all of the
919, right.
excess and deficit.
So all that, like the 5 million in the sewer fund, I think we need a projection of that at year's end where that will be. And if we need to adjust, if it's running, if we're keeping an extra million because we think we should, then we should just adjust the reserve fund.
And maybe a related point. You talked about a potential use in the general fund to fix the long-standing issue in the insurance fund. It would be great if you could find a way that are there miscellaneous excess fund balances in some of these miscellaneous non-general fund accounts that would make it possible to not have the general fund have to find $3 million to fix the insurance fund. If there's no other way, but it would be helpful not to have, is there a way that the general fund just doesn't have to take that out of its reserves to fix the insurance fund, which is not going to get fixed any other way? Parking, you said maybe would. That can be fixed long-term by less of a transfer, but insurance needs to be fixed. Is there a way to help with some of these other less restricted
it could come from
funds?
The other fund which come to my mind, which we separated 5 years back from general fund, is the human service fund. This is our own fund. But I guess we are projecting deficit for that fund even at the end of 2024 with the programs, kind of right now based on a conversation with the department. Other than that, all this, obviously Clayton went through all the TIF funds, special revenue funds, enterprise fund, pension funds, all those funds, they have some kind of restriction,
I think bottom line, good start here, good visibility. We can't end up with a 24 deficit of 16 and 20 and 25, and so that's our work, right? How do we How do we fine tune the revenue numbers, right, as much as possible, taking best current view on PPRT, best current view on sales tax, all these other elements to really understand what is, as we work on the 24 forecast, how do we get to a final number that makes sense? You know, some use of excess reserves, given our starting point, is probably reasonable, but we cannot see all of these excess reserves get depleted over the next 2 years. That's too much of a use of this sort of windfall in revenue that happened over the last couple of years. And I think that would be, you know, that would not be responsible, but I imagine there's also some upside in revenues. So how do we get to something that is more, makes more sense? And also, I think we need to recognize there's been minimal changes to the base property tax in several years. There could be other things. I'm not saying we're going to raise property taxes, but we're living in a high inflation rate environment, right? And so all of our expenses are subject to inflation. For us to take any of our revenue streams and say we're not going to change them, they're getting smaller every year then. We're creating the structural deficit. So understand a desire to keep water rates the same. Understand a desire to keep property taxes as low as they could be. But when every other expense is going up, we need to understand what are the causes of the structural deficit.
But it's a double-edged sword, inflation, too. I mean, we have increases, as have been pointed out, in revenue because of inflation also. So it goes both ways.
Exactly. So what is the source of any structural deficit, and how do we eliminate it, and how do we make the tougher choices? Because we're getting to the tough choices, right, of what's expenses that we can't do, that we've been able to do maybe because of excess revenues. How do we minimize and not end up with, again, it's what it should be. First cut, -16, -20. Okay. How do we make that less? Because we can't get to a depleted reserve balance by 25. We need to get back to this sort of break-even situation that existed in 19, where we're raising enough money, it's growing fast enough, and we're in balance with the general fund expenses. I'm sure we would all agree that's where we want to be, and that's where we have to get to. So,
All right, thank you.
So I did not really prepare a presentation on the general obligation bond, other than the information that's in the packet. But essentially,
Hold on one second. Next on the agenda was the water fund discussion.
so there have, because of some of the issues with how the audit was prepared, as we were trying to fine tune the numbers for the general fund, or the water fund, we were struggling with, we maintain a rate model that we look at in order to determine our best rate that we want to charge either our wholesale or retail customers. Short story is, we have to pull that off this meeting and bring it next meeting because of some challenges we were having pulling the information out of the actuarial report.
Okay, so there was 23 pages in our packet for this month. Disregard, we'll pick it up next time.
Disregard, we'll pick it up next time.
All right, thanks.
So I will go on with general obligation bond, but essentially I didn't actually prepare a presentation. There's information in the packet that basically indicates that every year we approve a bond resolution early in the year that allows us to spend against a future bond resolution. There are many reasons why we do this, not the least of which is it better allows our finance group to time the bond market. And it also coincides kind of with the date we've always sold bonds. And so in the recent years of lower bond rates, interest rates, we've been refinancing bonds, but we have to wait until a certain date is hit that coincides with the date that the bond was originally sold. And so we have a pattern of selling bonds mid-year. And for this reason, we approve a bond resolution. Now, there has been some volatility in the bond market this particular group has been looking at how to time the bond markets, and we delayed selling the 2022 GO bonds, and the 2023 GO bonds would typically be sold right about now in order to meet it. The net impact of this is we have developed a pretty substantial cost commitment for contracts that are under contract, that money is rolling out the door. Is approximately $15 million right now of construction commitments in the capital fund. We currently have less than $3 million to pay those construction commitments as of June 30th. I can tell you the last two council meetings, the second council meeting in July and the council meeting last night by themselves were $2 million in costs or payments that are coming out of the capital improvement fund. So we are at the point where we respectfully request consideration of selling bonds. However, I will state that typically what happens in a budget year is we put up $12.5 million in projected GO bonds when the budget is adopted, but we target selling $10 million or less of general obligation bonds, again, to kind of keep some balance with the debt that is rolling off and the debt we are bringing on. So of the last 2 years, we projected between those 2 years, 22 and 23, about $25 million in general obligation bonds, and we project selling, a need to sell approximately $19 million in general obligation bonds to meet the construction commitments that we have. That's what I could do from memory, but I'm happy to answer any questions. We're just requesting guidance on how to move forward with the GO bond sale, whether we sell $19 million worth of bonds, whether we offset some of that from general fund reserves, whether we delay selling them further, although that is starting to put us into a little bit of a bind.
I guess just philosophically, this whole idea of, 10 roll on, 10 roll off, I wouldn't have liked that in the past, but at least that was rolling on and off with interest rates that were generally in the same area. Now we're not in that environment at all. So to me, just kind of issuing bonds to, when I pay down $20,000 of my mortgage, I certainly don't just go out and finance $20,000 more just because. In the in 2020, in April, we learned that there was $38 million of surplus. In 2021, we learned there was $30 million. In 2022, there was $55 million, and we were told all those things in about the April-May vicinity. So to ask us to make decisions when we don't really have an understanding of surpluses, I don't think is good practice, frankly. And I strongly would encourage us to look at using reserves for this rather than going out and issuing bonds. I just don't think we need to. Also, we went through the exercise of putting into place a line of credit. So if we do find ourselves in a short-term pinch or we need those funds, we can always draw on those lines, and then we can go ahead and get a better idea 6 months later of where the reserves really landed, and then go ahead and issue a bond. And frankly, I think we're probably getting to the top of rate, so I don't know why we'd go out and issue now. I think there's a lot of arguments against doing this.
So if I could say that the implication of not doing that is we need to fund these projects through the general fund, right? Or through existing revenues, right?
Yes.
And so, there's a certain capital base within the city, and we have to keep it updated. And I think if the general direction is we're driving debt down, but that's good. But to take all of these expenses and in effect push them through existing revenue sources, we already have a projection here that we're trying to manage that we would be, depleting the excess reserves by 25. So I think we've delayed 2 years. It seems reasonable that they're,
Historically, not done a very good job of, we've very much estimated our revenues and overestimated our expenses. So I think those 25 numbers are probably pessimistic. So, and again, we do have the access to short-term lines of credit, David, where we could, look at where we really are. And I don't think we're going to be hurt by doing that.
Mr. Desai, you want to talk about where we are on the lines of credit and
I mean, I
the
can
relative
bring up-
cost?
Yeah, I mean, the first thing, yes, we do have a line of credit of $15 million.
Yeah.
The other thing which some of them might be aware of, that the property tax from Cook County has been delayed by 4 months again. So that's creating a cash crunch.
why we have
Generally, we
short-term
would
line
get
of
the
credit.
money in July, August. But now they say they will send the bill out in November with the money starting flowing in December. So, and that's a huge amount. you know,
And
property
that's the
tax.
beauty of those lines of credit.
And, yeah, so line of credit, obviously, we will end up paying, I don't know, maybe 5.5, we'll see where we end up paying the rate, since we
But
on
you
to
you
5.5.
you only borrow, you only pay for what you need. You're not sitting
And
there with,
I agree with you, yeah, it's not a
you're
bad
not
thing.
sitting there with long-term debt that maybe you don't need.
Right, the concern for me is considering the projects approved by that, okay, how long we can sustain on the line of credit? 2 months, 3 months, 6 months, or 12 months, or 16 months?
Well, I mean, I think what you do is if you see yourself getting to a permanent level of debt on that line of credit, that's when you go and you access the bond market.
And again, yes, I mean, we wanted discussion, as Lara said that, and we see that, okay, council has approved projects last year, this year. We kind of somehow, moved money, you see already like 6.6 million. And the other thing is not only the project itself, most of the projects, the side effect of the inflation is they run into overages. And some of them are substantial overages. So we have already transferred 6.6 million, the council has approved this year. And I'm ready, I mean, this is the purpose, that's why, I mean, Lara and I talked about it and said, let's see what's the committee's direction in terms of timing of the bond issue.
Yeah.
And if they say yes, what kind of amount, 10, 15, $20 million.
And I also think we should, David, get that subcommittee, the capital improvement subcommittee up and running, because it seems to me like we need to have more understanding and clarity around why we keep having these overages and where we can cut costs.
Sure. Jonathan?
Thank you. I'm not philosophically opposed to selling more bonds. I think we're going to have to. Like, that was the assumption for the last 2 years when we authorized the eventual sale of bonds and started funding projects under the assumption that we would eventually sell some bonds to pay for any number of projects. So we're going to have to at some point. When is the right time and at what amount? That's something where we need to take the expert advice of our financial professionals, including those on the staff as well as on this committee. And so I want to hear that advice. I want to have that discussion. But at some point, we're going to have to sell bonds. When is the right time? That's where I'm going to need some more input.
At some point, we probably will. But I do think that the line buys us some level of flexibility so we really have a good understanding. So we're not issuing debt for the sake of issuing debt. And, I guess I don't understand what's going to change between now and 2025 when we have struggled to, we've had these enormous surpluses. What, are you saying, now we kind of know what, with a great deal of clarity?
I think there were a lot of unusual items that happened over the last couple of years, due to the pandemic, due to the ARPA funds, due to the loads of open positions that created enormous volatility on line items in the P&L that made it hard to forecast, but also at the end of it, I think we can all be, at the end of all this, good. We're ending at a higher fund balance. It's good that it didn't go the other way.
That's a good problem to have.
It's good that it didn't go the other way. But how do we get to this steady state? And it is a normal course to have some level of renewal of debt that is maturing when we also have new projects. So what's the right amount to get our toe back in the bond market after we haven't been there for 3 years now?
We issued in 21.
21, okay,
Right.
okay, so
Well,
it'll be 2 years now.
But I mean, why did we go through the exercise then of putting into place the line? I mean, why don't we give that a try?
Well, we
And I
have the
numbers. I
line,
mean, I have
we have the
tentative
line,
numbers, it
but
says.
But we haven't drawn on
I
it,
think
have we?
more
now-
typically,
what's that?
is something like a working capital line is used to fund things like the county being late 4 months in the property tax disbursements, so.
And we have the line of
Right.
credit, I mean, absolutely.
I know, but
And-
have you ever drawn on it?
No. And this is the like rate, I got the numbers last week from our financial advisor, based on the current environment, it's like the interest cost is running around 4.2.
Yeah. I mean, the great thing about them is that it gets, it gives you a level of what really is permanent capital at some point, and then I think you issue.
And the other thing is, I'd just like to mention, as Chair mentioned, yeah, I mean, we had a lot of openings, hiring freeze post-COVID. That's filling up. Last year, this year, we are adding up. Then the other big one is ARPA. ARPA is running out next year.
But we
And
wouldn't
which
be.
used to fund,
I'm sorry.
ARPA, like suppose say vehicles.
I mean, I don't want to interrupt you, but we wouldn't be funding salaries with the
No,
bond.
no. Let me give you the example.
Yeah.
That's why I'm getting to the
Right.
example. Like vehicles, some of the vehicles which we could buy because we call a loss of revenue, which is like a lot more unrestricted category in the ARPA. So we bought the vehicles, we transferred the ARPA funds to buy the vehicles.
Mm-hmm.
Typically, where does the fund come from? General fund.
Yeah.
We transfer from general fund to the equipment replacement fund. Now that would happen starting next year, as I think almost all the ARPA funds have been committed, except some last $500,000 also.
But I guess my point is, while we have the luxury of these surpluses and the luxury of not having to issue debt, let's not do that. Let's not incur those interest costs until we need to.
Well, I think we will, if we draw against the line, we'll incur the interest costs. In fact, it's
Well, but I mean,
more
that's
expensive.
probably not until 2025.
Oh, I
If we
think
issue-
if we have 15 million of commitments and 3 million of cash, so we're going to have to come up with 12, right?
Right.
Is that
But we
in the
have
short term?
reserves. Go ahead.
Right,
Karen.
and we do have reserves, and we have to consider, we have excess and we have reserves. And I'd just like to know, and maybe also City Manager Stowe, you could answer for, I'm just looking at the last 3 years, we did not know during budget season, we were, we had well over 25 million in the case of last year, we ended up with 57 million, but we were told we had 14.1 million when we were debating and deliberating over how to allocate funds. So I would, and I know from being, from working with a lot of other cities on National League of Cities, that it's not really normal to not know that you have like 57 million in excess funds and unassigned funds, as is stated in our audit. So, City Manager Stowe, do you think this year we will have a closer, will we be able to have a more realistic and closer estimate as to where, and not have to find out the subsequent year in April or May or now in the case of almost September, where we're at?
Sure. Good evening, committee members. Luke Stowe, City Manager. Clayton and I have had many conversations about that exact thing. He's worked really hard over the last several months to make sure that we're better, we're fine-tuned on that. He has some tools that he used at Schaumburg that he's introduced here to make sure we do a better job. I just want to be clear that at one point we thought it was going to be 14 million, ended up being 26 million. But the 50 million that you're referencing, that's our general cash balance. That's not the surplus.
Those are unassigned funds. That's excess.
Right, but I don't
That's
want to
surplus.
conflate the 26 million with the 50 million. The 50 million is our cash reserves. The 26 million is the surplus.
Right, it's all
2020
surplus,
the
but
2022
nevertheless, it's
surplus.
57 that we ended up with at a surplus
Let
from,
me clarify
in
something.
unassigned funds. Whether it's 26, 14, 26, or 57, it's a large, we're missing the mark, and we have routinely, and no, but that's, I don't think that's
But let
debatable.
me clarify
For 3 years,
the Councilmember Kelly, 14 million was operating surplus for that year. 26 million was a real operating surplus for 26. 57 million is a total cumulative fund balance as of that date. So it's not an operating surplus, 57 million.
it
That's
is the
total
unassigned fund balance. Unassigned means surplus, so
No.
Yeah, but unassigned
It's
is,
not-
unassigned means that, that is money that we have not earmarked. And, I mean, it's clearly defined here. I don't think you're going to challenge me, though, that for the last 3 years, we have what the council has, when we have tried to figure out our budget, We have, now even, I've even brought numbers forward with the PPRT. I had numbers that, from the state, that were millions of dollars more than what you were presenting to council. So I'm just asking, and thank you, City Manager Stowe, if we can please have reassurance that this year we will have a more realistic idea as to what we have in unassigned funds
Right.
for the next year. That's all I
And again,
ask.
I'm not challenging that thing. I'm clarifying clearly the operating surplus is the result for that year only. When we say 14 million, 26 million, whatever. 57 or 55 million is the total fund balance. It's not just the effect of that year.
Yeah.
It is as of that
I
year.
understand that.
Right,
I
so
understand,
that's
but that number needs to be, we need to have that number presented to us when we're at council during budget season. We need to know those numbers and not wait. We shouldn't be finding out in April, May, June, or July what that number is. We should have a better idea, and not just the general fund. That 14.1, I believe, was general fund. And again, there's 10 funds that keep reserve balances, some, as we're seeing now, with excess, some $1 million excess already above and beyond the reserve. These are numbers we need to know. We need to know projected by year end where we expect those balances to be before we can talk about leveraging a 20-year debt on our residents at a high interest rate.
I'd like to bring the discussion around to that point, which is what our agenda item is providing some guidance to staff on our bond issue.
Jonathan, can I mention one other thing? One of the, and you make a lot of great points, is, you know, at some point, we will have to issue debt. One of the things I really like about using align those, I think that we can probably agree that Chairman Powell is closer to the end of raising rates than he is towards the beginning. So, I mean, I guess we're expecting sort of rates on the longer end to start to tail down. But with a floating rate line, we can also take advantage of that. As rates are coming down, our borrowing rates are going to be lower on the short term. So I think it just provides us so much flexibility, and I think it's a tool we should think about using.
Right, and it just becomes a math problem with, reasonable assumptions for interest rates.
I'll just add one other item of interest, which is that this time of year is when we see a lot of invoices come in for construction work that was completed over the summer. So I would anticipate in September, October, and November to see $2 to $3 million additional payments come out of the capital improvement fund as a matter of course as construction projects are completed for the construction season.
So Atesh, maybe what we need, and this was meant to be a discussion, we need to know, and we meet again in 2 weeks, if we don't issue bonds, what's that mean to the general fund? What's that mean to the cash balances? How much do you think that you will be into the line of credit if we do not issue bonds? And I would say, it doesn't have to be all or nothing. And again, we have retired, is it 25 or 30 million of debt over this same period that we have not issued any bonds. So to issue 10 or 15 is a lot less than what rolled off and was paid out of cash. So, but let's understand, if we don't do anything, what's the implication to our financials? How much will we be into the credit facility?
So in the short term, you won't see any problem. Why? Because we have a general fund cash. I can draw on line of credit. So there won't be like in next 3 months, 6 months. But as Lara said, more bills would come through, the new projects which are already approved by the council. So come next spring and say we are in the same rate environment, March, April.
How big is the line of credit, and what's the
15.
interest rate?
15.
And what's the interest rate?
The interest rate is, I think, 100 basis point above the
Plus
rate.
SOFR, or?
So it's like 6%.
Yeah,
It's like 100 basis points. So it's considerably higher than what we could issue bonds at now.
right.
So it,
Right, but you're only.
What's the implication?
You're only paying interest on the portion you borrow. You're not.
Sure.
If you issue a $13 million bond and then you throw it all in reserves, that you have a negative
but
arbitrage.
we earn 5, right? We earn 5 on cash. So it is, we are earning significant amounts on excess cash now. So let's understand what it means, but also the bond markets are open now. Bond markets aren't always open. We don't want to get into March and whatever, and we have another financing crisis, and we can't go to the market. So Again, it doesn't have to be all or nothing. We've retired almost 30, 25 or 30.
I mean, again, let's
Is there
clarify
some number that makes sense that we re-enter the bond markets at?
I mean,
And
we retired around 11 million in '21.
Can you tell us what the difference would be between our borrowing rate on the line and what you really think we can, so what do you think we can issue a bond at?
I mean, as I said, 4.2% right now, based on
So,
the,
so you're saying we can issue a bond at 4.2% and earn 5%?
yeah, I think so.
yeah.
I mean, that's sort of the weird yield curve that we're
Because
up
of the
against
long
now.
run, yeah, I mean, the high-end coupons in the long run, and so that's why, yeah, because it's a 20-year, I can call earliest at the 10th year, you know? I mean, I'm earning 5.5% on my checking account, which is unheard of. So, and I got a few issues, the FA, our financial advisor, shared with us where they issued the bonds, Spear Financial. And yeah, it's right around, even in some cases, it was a shorter term, the rate was even lower than this one.
And I'm not suggesting we issue bonds because we have an arbitrage with our cash account. I'm not saying that at all. But if, to the degree we do have excess cash, there's significant interest income. And the muni market curve and what we, I mean, the rates have gone up. If this is 2 weeks old, rates did move a
But
lot
most
in the
likely,
last week.
I mean, and most times, we don't incur even the arbitrage issue because we spend our money in time frame.
Yeah.
So, yeah, it generally doesn't arise the arbitrage issue either.
Item either.
Well, I think as long as until the Fed starts cutting.
Right,
think
but that's
that's-
not 20 years.
But I also think
You're borrowing at.
I think we should also be very
Sorry?
happy that this staff and that council last year, we did reduce our debt by over $11 million. And the city desperately needs to reduce its debt between what we owe in our public safety pensions and our GO bond debt. So I think that's the good news, and I'd really like to see us do everything we can to continue in that direction. So I think that's the really great news, is that for the first time, we really started turn things around there.
All right, so that was our discussion. I don't know if we came to any conclusions, but, there can be a middle ground here, right, between debt payoff and when do we want to reenter the market, and how do we want to treat the line of credit, and when do we want to, it's reasonable to, access it. Very reasonable, but.
But ideally, yeah, we would like some recommendation at some point. Yes, I can wait next meeting, next month, we can talk about it. So at least I can plan accordingly that, okay, I have to now say general fund reserve is going to fund the CIP projects for the next 3 months, 6 months. So I can kind of manage the cash flow.
I can't speak for the other members of this committee, but I'll speak for myself as a non-financial professional. It would be helpful for me to have some parameters of recommendations, a high, medium, low scenario, so I could understand the implications and the various factors that are involved.
Absolutely.
And ultimately, what specifically your recommendation is. I mean, we can talk about it, but you're closer to the numbers. And based on our cash flows, based on what you feel comfortable in accessing the credit line, what's your recommendation, right?
And as I said,
Maybe we can talk about it more in 2 weeks.
because, yes, you can challenge my recommendation if I say, okay, let's issue $10 million bonds, minimum. And you might say, okay, we have the general fund reserves, line of credit, all those things. So that's why we put all the information in front of you, what we have available, in terms of general fund reserves, the line of credit, what is the rate market for the bond, what we are earning on our own cash, all those things are, we wanted to put every information we have in front of you so you can make the right decision.
Anything else?
Who's on our CIP? I know we have a CIP committee, subcommittee.
Bobby and me.
Yeah, but I think we can.
And who?
We can.
And because I think it would be good if you all could give a report out.
Right, and that's another huge item for us to think about is all the big building needs over the next several years, fire, police, this building. There are some enormous things we haven't even touched on
Right,
relative
so I wonder
to
if
how
that
those are gonna be
subcommittee
financed.
could maybe give a report in 1 or 2 months, maybe not next month, but if that seems reasonable, that would be great.
Or at
Leslie?
least early in next year as we get through the budget cycle here. I'm sure the focusing on the budget will be a lot of what happens over the next several meetings, that and making a bond decision. So. All right, so with that, I think We are adjourned.